Hello and welcome. In this on-demand video, OJM Group partners Carole Foos and David Mandell discuss recent developments in tax and asset protection that could impact your wealth planning. If you have more questions or want to learn how to incorporate these topics into your financial strategy, click the link below to schedule a complimentary one-on-one consultation with one of our experienced team members.
Hello, I'm David Mandell, one of the partners at OJM Group, and I've got my partner Carole Foos on. And today's topic is hot topics in tax and asset protection. So I'm going to turn things over to Carole, and she'll get into the tax, and then she'll hand the ball back to me to talk about asset protection. Carole?
Thanks, David. Great to be with everyone today. I want to go through a few of the new things that happened and then just talk about some items that you might be thinking about as we approach the end of the year in 2022 and are heading into 2023. So first off, the Inflation Reduction Act passed this year and did have some impact on tax legislation, but not a lot for individuals or for small businesses. Couple of points that I wanted to make as it relates to the Inflation Reduction Act. There is an expanded tax credit for energy efficient improvements. So if you made any energy efficient home improvements this year, or have plans to make those in the future, there's a credit that goes through 2032, and the credit amount has increased to 30% of the cost of the improvement, up to a max of $1,200 per year. So that would be things like, new windows, energy efficient furnaces, HVACs, those types of things. In addition to that, for those of you who own a practice or another small business, and you might own the building that you're in, there's a credit for small business building owners also for energy efficient improvements. And that credit for small businesses is up to $5 per square foot of the building. So keep those things in mind. Talk to your CPAs about those. If you've done any types of improvements in 2022, just in terms of what documentation your CPA would need when it comes time to prepare your tax return. There's also, under the Inflation Reduction Act, a clean vehicle credit. Now, that credit has been in existence, but it used to be that each auto manufacturer that was manufacturing electric vehicles, only a certain number of credits per manufacturer were available to taxpayers. So those limits have been changed, have really gone away. Now that clean vehicle credit is available if the manufacturer's suggested retail price of a car is under $55,000 and you purchase that, it's going to be eligible for this clean vehicle credit. If it's an SUV, the manufacturer's suggested retail price can be up to $80,000 for it to be eligible for this credit. So look into that as well. Another point that I think is important for listeners to note today is the IRS recently announced the interest rate on underpayments and overpayments is increasing to 7% effective January 1st, 2023. I say this because I do think it's vitally important as we're coming into the end of 2022. Really work with your CPA to take a look at where you stand in terms of your withholdings and your estimated payments. If you do have an underpayment going into April of 2023, when your extension payments are due, that 7% rate is going to hit a little bit hard. So if you do need to increase your withholding on the last couple of payrolls of the year, That's a great way to get more taxes paid in because withholdings are considered to be paid evenly throughout the year, even if you have a much larger payment in December. Absent that, make sure you and your CPA have a good handle on your estimated tax liability for 2022 so you can increase your estimated payment that's due January 15th if you need to, so that you can avoid that 7% underpayment penalty. Keep in mind, there is a safe basis for estimated tax payments. For higher income earners, that safe basis is either having paid in 110% of your 2021 tax liability or at least 90% of your 2022 tax liability. That's how you're going to avoid an underpayment penalty. Additionally, next item on my list of topics is just managing the timing of your income and deductions. We're looking at 2023. I think it's important for you to take a step back, think about, are you potentially going to make more or less income in 2023 than what you made in 2022? What do your deductions look like? If your tax bracket is changing for next year, if you think, you're in the top tax rate this year and maybe you won't be next year, or vice versa, to the extent you can defer income into next year to push some of those taxes into 2023, that's always a good thing. You might want to think about accelerating deductions for expenses such as mortgage interest or charitable donations. If you're going to itemize this year, certainly you can speed those up to get a greater deduction this year. That's especially true for those of you maybe who are about to pay off mortgage interest, and maybe next year you won't be itemizing deductions. If that's the case, speed those charitable deductions into this year, pay those by December 31st, either by check or credit card, in order to take those itemized deductions this year in 2022. And then managing capital gains and losses is always important. I think for those of you who use an investment advisor, it's really important to talk to them about where you are in terms of capital gains and losses for 2022. A lot of advisors were making sales. As this year, the market's been pretty volatile. We've had a lot of ups and downs. So you might have either gains or losses that you want to try to offset by the end of the year. It's important because if you sold some things that were in a loss position this year, you need to understand capital losses are only deductible on this year's tax return to the extent you had capital gains plus an additional $3,000. So if you've got a big loss this year, losses, and no capital gains to offset them, those losses will carry into next year. So it might be worth realizing some gains, even if it's just to repurchase the same stock or essentially the same stock to increase your basis. So those are all tips for the end of 2022 and going into 2023. One other thing that you can do in terms of managing your capital gains and losses, if you're expecting a large capital gain by the end of the year, for instance, you're looking at selling your practice or selling a portion of it. If it's not too late to make that an installment sale, so you're only realizing some of that gain in 2022 and you can push some of it into 2023, that may also make sense. But most important of all, be speaking to your CPA and your investment advisor so you're aware of where things stand for your tax liabilities and your capital gains and losses.
Great. Thank you, Carole. I know everybody's paying attention to you, and maybe they'll be paying attention to me as I talk about asset protection, but tax is always on everybody's mind. And I'm doing a number of things that Carole talked about myself, and she's helping me as well as the investment team. So I will take the ball now and talk about asset protection. It's kind of a hot topic. So Again, what is asset protection? It is a field of planning that involves law, that involves insurance, that involves financial. And the goal of asset protection planning is helping clients like you put some shield around your either practice assets or personal assets or both in protection against any future potential liability, lawsuits from malpractice to car accidents and everything in between. And I did a good summary video, done a lot of videos over the years for ViewMedi that you can find on our page, but I did a good summary asset protection video in the fall. So if you're watching this and you want a kind of a refresher on what the tools are out there, take a look at that one. What I want to talk about today is just some kind of hot topics or some developments that have gone on in the law. So the first one is certain states have improved their state exemptions. If you go back to that video, you'll see a sliding scale of asset protection from -5 to +5. And the +5 is the top level of protection you can get. And those are state and federal exemptions. Every state has laws that say this asset cannot be touched in a lawsuit. And even the federal law has that. And some states, and every year, every couple of years, improve their exemption statutes. California is one that did that in the last couple of years. And obviously, California being the most populous state, I thought I'd mention it. Homestead in California, which is the amount of homestead, primary home equity that is protected for years and years and years, decades, it was somewhere between 75,000 and 150,000. So if you were, a married couple, physician, earning in your main years and not retired or older, it was about 100,000 was generally your protection. If you're single, it was 75. Well, they just passed a change to that where the exemption is now a minimum of 300 and a maximum of 600, and it kind of depends on what the average home sale price was in your county. But for those of you listening and are in counties anywhere near LA or San Diego or San Francisco or Santa Barbara, really almost anywhere by the coast, it's expensive enough that the average home sale price is more than 600,000, which means your exemption is 600,000. Now, California properties are worth a lot more than that, so it's certainly not anywhere near where I live in Florida with an unlimited homestead, or Texas or some of the other states, but it's certainly getting better. So the lesson here is make sure that you understand if any things have changed in your state. Most of the time, they get better. Some of the times they get worse, and you certainly want to be aware if there's a change in your exemptions if you're relying on it in your asset protection plan. Okay, now I want to talk about a couple of cases, actually 3 or 4 cases. And the first case regards a Delaware LLC. And the reason I want to cover it is even in my law practice, and I've been doing this for 30 years, Delaware was one of the states I relied on to create LLCs for clients, for physicians anywhere in the country, because they had what we thought was one of the best statutes in the country. Okay. However, this case undermines that, and it casts some doubt. And I talked to other attorneys in the field. We're kind of put a hold on new Delaware LLCs for our clients over the last year. And in fact, I'm even thinking about moving some of my law firm clients from Delaware to Ohio, as we'll talk about, because of this case. So in this case, it's called Manichian Capital versus Excella Technologies. In this case, it's a complex corporate litigation. I want to get into all the facts, but in any case, the plaintiffs here were owed under a statute, tens of millions of dollars from an LLC. But that LLC didn't have much capital in it, not much money. So what they petitioned the court at the beginning of the lawsuit was to do something called reverse veil piercing. I'm going to use quotes, air quotes, reverse veil piercing. This is a legal theory that basically means we want to go up the chain, not just we have a judgment against this LLC. We actually want to go up to the parent. Okay. And most attorneys expected this claim to be rejected by the Delaware court because of the statute that it had. So many of us had created LLCs there because we figured it wouldn't be allowed, because the statute says the charging order, and I've talked about this in other videos and it's in our book, the charging order should be the exclusive remedy. Exclusive is right in the statute. So that's what we were expecting. Okay. And this charging order is not a very beneficial remedy to a plaintiff. They can only get profits to come out that do come out. They can't get inside anything. So we all expected that this case, the court would reject that reverse piercing claim, but they did not. Okay. They allowed the case to move forward. And most of us in the kind of field were kind of shocked by that, because Delaware had been known as the reason why so many corporations moved there on the corporate side. This is on the LLC side, but they've been known as a very pro-business jurisdiction. But yet this court said, no, we are going to allow the plaintiff to move forward in this case. And I don't want to get into all the details, but it's not typically the same kind of situation that a physician with a bunch of assets in an LLC has. But that same theory could be used to get inside of an LLC that a physician has. So we're, I think, rightfully on guard because of that case. So, what's the takeaway here? I think there's two. One is that you got to keep an eye, or your advisor needs to keep an eye on rules like this, because it's not set in stone forever. Again, if Delaware can do this, we have to expect that lots of other states could. And as I said, my law practice, we're thinking about re-domiciling our clients from Delaware, at least giving them the option to move out because of this case. And I happen to know that, it's been a very popular entity. So I imagine some of you listening or watching, and certainly I would guess hundreds, if not thousands of physicians have used Delaware LLCs over the years. And they were probably right to do that at that point, but it's probably right now to reconsider that. So jurisdiction matters. Okay. The state you choose matters, and it can change. All right. That's what I want you to take away. All right, now we've got two cases in Ohio that kind of do the opposite. They actually show the strength of Ohio, and it's a good juxtaposition to the Delaware case. One's called Wick v. Atch, and the other is Burns Custom Homes v. Johnson. Okay, so this is a good example of how cases can actually improve or solidify a state. So in the Wick case, the plaintiff, Wick, brought an action alleging many causes of action, including reverse veil piercing, the same thing that we just saw in Delaware against Axis LLC, or a number of LLCs, actually. The trial court dismissed the reverse veil piercing claim. So they said, yeah, these other things can go forward, fraud, et cetera, but not reverse veil piercing. We don't allow that in Ohio under our LLC law. You can't get in there in that type of claim. They said it was not a valid legal claim, and the appellate court, because they appealed that, the appellate court confirmed, or what we call affirmed, that. Okay, so here the courts are clearly indicating that under Ohio law, reverse veil piercing against an LLC is not a valid legal claim. Okay, that stands in sharp contrast to the Delaware case I just mentioned. Okay, the Burns case. Here we have another case attacking ownership interest in an LLC. The plaintiff asked for a receiver to be appointed because receivers have significant powers to penetrate LLCs for plaintiffs. Okay. The court rejected that claim, again, stating that Ohio LLC law does not allow receivers to be appointed in a claim against an LLC membership interest. And that Ohio law is clear that the charging order is the sole and exclusive remedy for plaintiffs in this situation. Again, this is exactly what we want to see as asset protection advisors and attorneys, the courts confirming and affirming the protections that the statute gives us. We got two great cases in Ohio, which is why it's part of the reason why I think Ohio is the best state in the country now. And we just, as I mentioned at the outset, we saw Delaware actually moving in the opposite direction. Okay, so again, what's the point? Jurisdiction matters, and these things change. Some get better, which Ohio has, and some are getting worse, like Delaware has. Final case I want to bring up is a case involving the IRS. And I wanted to bring it up because it's a very common situation, and I bet a lot of you are in this situation with real estate, okay? Many physicians own real estate through their LLCs, either through the practice where they separate it, which is good advice, or they have rental properties. And this is a classic case of not following the formalities of an LLC and then being open to the risk that the LLC doesn't work the way it was intended to. Okay, this is called TBS Properties LLC versus United States. Okay, an IRS case. In this case, an Arizona corporation was found liable for over $150,000 in unpaid taxes from 2015 to 2017. The corporation owned and operated a restaurant in the Phoenix area. The real estate on which the restaurant operated was held in a separate LLC, right? Common advice, separate the eggs in different baskets. And some common advice for physicians to get with their practice, separate an LLC and then lease it back to the PC, the professional corporation. Okay, back to the case. The corporation operating the restaurant was owned by a family trust and the LLC was owned by a marital trust, but the same taxpayers had set up both the family trust and the marital trust, and the trust had the same co-trustees. In an effort to collect the corporation's unpaid taxes, the IRS entered a lien against the real property owned by the LLC, asserting that the LLC was the alter ego of the corporation and hence was liable for its debts. The district court denied the LLC's motion for summary judgment. Summary judgment basically means at the outset of the case, going to the court and say, get rid of it now. We don't even want to get into the facts. They don't even have a legal case because they're bringing it against the wrong entity here, right? The corporation owes the money. They're bringing it against the LLC. But the court said, no, we're going to allow the case to go forward because the IRS put forward sufficient evidence to support his alter legal theory in the beginning. Again, this case hasn't been decided on its merits yet. This is just, could we even move it forward? And the court said yes, because the IRS showed that the entities had common officers, directors, and owners. Okay, that's pretty common. Here's key. The entities failed to enter into a formal lease agreement. I don't know how many times I've told physicians you have to have a lease, even if it's your LLC to your corporation. Why? Because of cases like this. And number three, the corporation routinely transferred money to the LLC without appropriate formal documentation. So the money was just going back and forth with no lease. And the IRS said, well, if you're doing that, then we're not going to respect the formalities. And the court, at least at the outset, said, you're right, we're not. We're going to let the case go forward. So what's the lesson here? Okay. Formalities count. At my law practice, we make sure we have an annual meeting. I make sure I'm checking up on the clients and they're doing what they need to do with their LLCs and their corporations. And this is a case that shows why. So a couple of quick cases. One, jurisdiction counts. They can get better. Ohio, they can get worse. Delaware, and follow your formalities. That's your asset protection update. If you haven't done these things, you probably should. And if you have these entities in place, but you haven't kept your eye on them, maybe 2023 is the time to get a hold on that. So thank you, Carole, for being on. Thanks for everybody watching. Obviously, we've got a lot of videos. And if any of this is of interest, feel free to reach out to us, get our free books. We're happy to do a consult with you.
OJM is a multidisciplinary wealth management firm. We specialize in working with doctors, and our team has helped physicians reduce taxes, protect assets, and achieve their financial goals. Don't forget, OJM Group also offers viewers a complimentary consultation where we can answer your questions to see if our firm might be a good fit for your situation. Simply click the button below to schedule your free consultation. And if you haven't already,